Good day, everyone. Financial markets saw a rocky start to the year as artificial intelligence enthusiasm clashed with geopolitical volatility in the Middle East and concerns over high AI related capital expenditures. Global growth remains resilient despite the challenges posed by trade policy uncertainty. With the war in the Middle East significantly impacting the oil and gas supply, equities and bonds sold off globally as markets focus more on the upside inflation risks than the downside risk to growth. Starting with the US equities, the S&P 500 was down 4.4% in USD terms in the first quarter. The primary driver was the US interest rate expectations that shifted from multiple rate cuts to a full pause by end of Q1 2026 as surging oil prices triggered by geopolitical conflict and the reignited inflation fears. Overall, global equities, the MSCI All Country Index was down 3.2% in USD terms but ended the quarter flat in yuan terms, due to the offsetting effects of the strengthening US dollar. Interestingly, emerging markets MSCI EM outperformed its developed counterparts again, finishing the quarter nearly flat, down 0.2% in USD terms and up 3.1% in yuan terms. Positive AI sentiment supported Taiwanese and Korean stocks prior to the Middle East conflict. Global property had a slow but steady start to the year, returning at 0.6% in USD terms, and for South African investors, the return was much more higher at 3.9% in rand terms because the rand lost value against the US dollar during the quarter. Global bonds, hampered by concerns over inflation risks and higher oil prices, delivered negative returns for the quarter, down 1.1% in USD terms, but up 2.2% in rand terms. Back home, after reaching an all-time high early in the quarter, the local equity markets, the JSE All Share Index, was not immune to the impact of the Middle Eastern conflict and the broader emerging market sell-off. The index suffered one of its worst monthly drawdowns during March, falling 10.5% and trimming back early year gains, ending the quarter down by 0.5%. However, following on the back of very strong returns during 2025, primarily driven by the resources sector, the index is still up a healthy 34.1% over the last 12 months. South African nominal bonds also experienced a major repricing in March, down 6.8% for the month and 3.4% for the quarter. And this is due to rising inflation concerns as a result of higher oil prices. Cash delivered a steady return of 1.7% for the quarter and an annual return of 7.3%. On the back of market turbulence amid the geopolitical conflict during Q1 of 2026, the MFP Focus 3 was down 2.5%, while the Focus 5 and 7 were down 3.2% and 3.3% respectively. The Momentum Focus Fund of Funds delivered returns of a minus 1.9% for Focus 3, while Focus 5 and 7 were both down 2.2% for the quarter. Over 1 year, the fund of funds as well as the model portfolios have still delivered strong positive returns ahead of their benchmark and their peer group. The end of March 2026 also marks 5 years since the inception of the MFP Focus 3, 5 and 7 model portfolios. So now we have a live 5-year track record on these portfolios. We also recently launched the MFP Focus 7 tax-free savings portfolio as well as the MFP Stable and the Growth Hedge. They are now older than 3 months, so we'll include them in the updates going forward. Now let's take a closer look at the global managed solutions. All 3 global managed solutions delivered negative dollar returns during the quarter, ranging from a minus 1% -0.3% for the cautious portfolio, -2.5% for the managed portfolio, and a -3.8% for the gold portfolio. There was no shortage of economic and geopolitical events in the first quarter of 2026, and there is still a high degree of uncertainty around the interim impact on the markets. However, it is critical for investors not to overreact during times of heightened volatility, as this can lead to locking in losses and missing out on the market's best recovery days, which often follow sharp after the downturn. Please join us for the upcoming Outcome Matters session, where we will discuss the topic in greater detail. That said, staying invested contributes significantly to how successful one will be reaching their investment objectives. So remain invested. Thank you.